Hi, everyone, and welcome to the ESG Exchange, to our First Tuesdays event. This is our second First Tuesdays event. And please let us know where you're from in the chat box. You can see the chat box function at the bottom. If you can't see it, click your Alt button. It'll pop up so you can see your chat box. We have also enabled the Q&A and, importantly, the emojis, the reactions. So please, if you like something, clap, go mad, and let us know if it's something that you agree with. But specifically in the chat function, please let us know any questions you might have. Let's put them to the panel and have a discussion. Today, unfortunately, Shameela, the sustainability officer from the Johannesburg Stock Exchange, is ill, so she is not able to join us today. But we do have the rest of the team, the panelists here, and especially Prof. Bose from New York. I think you're in New Jersey. And Ann-Maree. Ann-Maree, are you in Cape Town?
Actually, today I'm in Joburg, so
okay.
normally in Cape Town.
And of course, Alex is here in Cape Town. And thank you. Welcome, Paco from Gaborone. Very nice to see everybody online. I see that we are at the top of the hour, and I know that people are going to start joining, and the numbers are going to start increasing. But I'd like to hand over to Alex now and start the webinar. So thank you very much for joining us, everyone.
Thank you, Carolyn. Good evening, good afternoon, good morning, depending on where in the world you are connected from. Welcome to this ESG Exchange First Tuesdays webinar. This episode is kindly brought to us by the Johannesburg Stock Exchange. I'm Alex Hetherington, a keen student of all things ESG. And tonight I'm introducing a topic that is very much on trend at the moment in the media and elsewhere, and that is ESG, or sustainable investing. More specifically, what we're hoping to do and achieve today is do a deep dive really into whether the investor community can be a key driver for sustainability. Do traditional investors adequately understand sustainability? Are they even remotely interested in it? And critically, can an ESG lens help investors identify where the market might be mispricing assets or projects? It's been a boom time for ESG in terms of capital inflows into so-called ESG funds. Last year alone, over 12% of assets under management in the United States were directed towards such ESG funds. But this ESG investment wave has not come without its critics, both in terms of the value that ESG can bring to an investor, but also criticism of claims of greenwashing and minimum actual ES or G benefit. So to help us unpack these questions tonight, we have two very well-versed guests who we will be taking the deep dive with. But as always, we will have afterwards be opening up to questions from the floor and from attendees. So please do put them into the chat box. We will try our best to get to as many of those questions as we possibly can. I have a sneaking suspicion there will be quite a few tonight, so we will do our best in that. So with me is Professor Satyajit Bose. Professor Bose is the Associate Director of Sustainability Management Program at Columbia University in New York City. He is also the Director of Columbia's Certificate Program in Sustainable Finance. Professor Bose is a former mergers and acquisitions manager and a quantitative investment manager at a New York hedge fund. In 2019, he co-authored with Dong Guo and Ann Simpson an authoritative book on the subject entitled The Financial Ecosystem, The Role of Finance in Achieving Sustainability, which was published by Palgrave Macmillan. I think, Professor Bose, we're going to be challenging you on that final part of the title, whether finance can achieve sustainability or not. Then right out of the investment world herself, we have Ann-Maree Tippoo, portfolio manager at 91 Global Asset Managers. Ann-Maree started her time at 91 as an ESG analyst and is now the ESG lead on 91's 4-factor investment framework. She holds a business degree in actuarial science and a Master's of Commerce degree in development finance, both from the University of Cape Town. As Carolyn mentioned earlier, we were hoping to have Shameela Soobramoney from the Johannesburg Stock Exchange. She's the Chief Sustainability Officer there, but unfortunately she is unwell, and we wish her all the best and a speedy recovery. Professor Bose, if you don't mind, I'm going to dig straight in with you to just give us feedback and your thoughts around why ESG or sustainable investment at the moment is getting such negative press. Where is this coming from, and are these reservations well-founded?
Thank you, Alex. So before I answer the question, let me just thank you. It's a real pleasure and privilege to be on this webinar with you. As Alex mentioned earlier, I grew up in Zambia and Zimbabwe, and I've spent a lot of time in South Africa. So this is the first time that I'm speaking in front of a webinar organized in South Africa. I'm chuffed to be here and joling with you guys. And I think this is a lacquer venue to be invited to.
You're with your own kind here, Professor.
So thank you very much. So let me answer your question about why the controversy. And I would say, there's a lot going on here. There's a lot to unpack. I think what the definition of ESG is open to debate and is really held in the particular aspirations of lots of different investors. ESG is not a monotheistic religion. It's an animistic religion. That is, if you think about animism, it's you go out and you look at a tree, and the tree that gives you sustenance and fruit, you pray to that tree. And then somebody else in another climate lives in a desert and there aren't any trees there. And instead they draw their sustenance from oases and from travel and a nomadic lifestyle. And ESG is about what are the non-financial factors that make it possible for us to sustainably generate return. And that return is not just financial return, but it's the return that allows us to enjoy the benefits of that financial return. We can't have a single definition of that ESG. So I think the reason for the backlash, the controversy that you're seeing today is a relative monopoly on the definition of ESG. When you listen to the sort of other side, so to speak, in the US, the pension funds from, say, Texas or Florida that have refused to incorporate ESG into their investment management process, they talk about the politicization of investing. And that is a real problem. I'm very sympathetic to that question. We have to allow, ESG is supposed to be a democratic approach. It's supposed to listen to every saver's concerns. You have to ask, why am I saving? And typically, people save for all sorts of reasons. I mean, in the financial ecosystem book, we talk about savers in Zimbabwe who are saving in the form of cattle. It's a form of saving, right? Why are they saving that? They might be saving for their children's education. They might be saving for their retirement. They might be saving for an irrigation project. And those kinds of savings require you to think about the ecosystem in which the fruits of your saving will be utilized. That means thinking about the environment around you. It means thinking about the social network that you rely on in order to have trust and young people who are able to find good jobs. It means thinking about governance so that there isn't corruption in the process of, in the world in which, suppose I were to save well and I were to generate a high return. And then at the end of 20 years, I end up with a nice bank balance. Well, if that bank balance is usable only in a world where there's air pollution, there is drug-infested violence, or there is a corrupt government that I cannot trust, then what's the point of that bank balance, right? And so that's really what ESG is about. It doesn't mean that a few raters, for example, can decide what ESG means for everybody. And so that's why you're seeing that controversy. What I would say is that pretty much everybody I know on both sides of this debate are interested in the right things. What they disagree on is the label. And so let me stop there. There's a lot we could discuss, but I don't want to. This is not a lecture.
No, I just before I hand over to Ann-Maree, I'd just like to ask on one of the points you made. You talked about a monopolization of I'm assuming you're saying of the ESG label. Could you unpack that a little bit?
Sure. It's not a it's not a regulated monopoly in any sense, but there's a view or there's a sense in which one thinks, oh well, if I want to be interested in ESG investing, all I have to do is find an ESG fund. And what's the definition of an ESG fund? Well, it might be a fund that incorporates ESG ratings into its portfolio construction process. And there are 3 or 4 or 5 major ESG raters. There actually used to be something like 20, but because there's been so much consolidation in that business over the last 10 years, all the different providers got bought by just a few. So that's the maybe monopolization is not the right word, but concentration is a problem. There's a concentration in the ESG labeling business. But you don't have to take it that way, that no one is requiring you to use particular ratings.
Perhaps I can contribute here too, just from an investment perspective.
Please come in, Ann-Maree.
Absolutely, the idea of the subjectivity of this notion of ESG. Every kind of investor has a different objective and aim. Is I think top of the list when it comes to the backlash. The second thing is obviously what industry is labeled greenwashing, and that accompanies the subjectivity. What do we mean by ESG? And so I think people rightly and wrongly have been labeled as greenwashing their funds. And then a third thing is that I think for a lot of investors who really want to see change in the world and real world impact, don't like ESG funds, because many ESG funds exclude any companies where there might be the ability to change or influence or grow. And so you're actually just having these very artificially green or very artificially AAA rated funds, which are unable to realize real world change. Investors then, if they're not in the funds, they no longer have the ability to influence strategy and direction. And so I think there's a little bit of discomfort, and we've at 91 found this a very interesting talking point when we go to the likes of COP, etc. As an emerging market player, we simply cannot just discard companies because they are poorly rated. And so we bring this interesting element of you have to work alongside, you have to engage, you have to assist these companies in driving sustainable agendas so that we have a world to live in and a world in which we can enjoy the fruits of our savings, and a world in which they can continue to exist as well. And that, I think, also adds another layer. So divesting or not allocating capital is not always the solution. I think a lot of ESG funds kind of that's the first port of call. You want a fund that has majority AAA rated from the likes of, or one of the third-party research providers. Let me not name names here.
Yeah.
And that might not always be congruent with those ideals.
Yeah,
thanks.
If I could support, what Ann-Maree just said, and sort of enhance it, is that, Ann-Maree, you point out that in emerging markets, a lot of the issuers might be low rated, but we have to work with them. It actually even goes beyond that. There are a lot of emerging markets issuers that are low rated, even though they're really great, probably better than, So, I mean, we had an experience at the Earth Institute. We work with the Inter-American Development Bank, which is focused on Latin America. And we helped them to design an ESG index for Latin America. And we found that the major information provider in this area, they didn't have anyone who read Spanish sustainability reports. As far as I know, Spanish is not a dying language, but you have a major, major information provider, worldwide renowned, that doesn't seem to know that Latin American companies often issue Spanish sustainability reports. So until they got translated into English, the KPIs that were disclosed on those sustainability reports didn't show up in the provider's database.
Yeah.
Right. I think those are also issues that we might pick up later in terms of identification of mispricing when we're talking about future ESG performance and of companies and stewardship by investors. Ann-Maree, I'd like to bring you in here because you will know this. To what degree do you believe traditional investors are properly trained and properly skilled in understanding ESG from an investment perspective?
So there are a number of points there, Alex. I think the first thing we've already touched on, that ESG can mean many things to many people. And so I think there are investment professionals who have various understandings and are trained in different ways to use ESG. I think the easiest port of call is often just using ratings, and that is not an incredibly enhanced or insightful ESG method, if I can put it that way. Understanding ESG takes a lot of hard work, and unfortunately, many investment professionals feel they're quite stretched already. So if I, look to my peers in the industry, not only at 91, and you talk about ESG, they just, this just feels like there's not always a lot of time, and so it really has to be kind of core and center and prioritized kind of from a top-down perspective and from a really an embodiment perspective that analysts and investment professionals can understand it. So I'd say coming into it, levels of understanding are low because a lot of the issues are quite complex. They are quite technical, particularly on the climate front. They can become very technical, and you can deal, mining, property, real estate. They've each got their own set of issues, and to know each of those elements well, just within, let's say, the environmental kind of line of thinking, there's a lot to be done there. So I think from an investment house perspective, the ESG team or the sustainability team won't ever really die because there is this support that one needs, but it does have to live with the actual investment professional making the decision. So unfortunately it is low, but I think it's growing, and it continues to grow because many investment professionals realize that this is not just ESG and nice to have. ESG things impact the investment case, and you have to understand these intricacies. On the social side, for example, again, it's an incredibly complex set of data, set of communities, set of systems to work with, and so levels are potentially, I would say, low, but growing, because the way the world is progressing, I mean, I think you would be, anybody would call you a fool to turn a blind eye to what's going on environmentally and socially and from a governance perspective. Yeah, so that wasn't a very encouraging message there. But I mean, I think the likes of our our business, send people away on courses, and now we've actually we're developing an in-house transition school. So basically teaching a whole set of curricula for us to digest internally about, well, how do we help companies transition towards net zero, for example, and what are all the sets of technologies we need to understand, and bringing that internally, because we understand that we have to upskill investment professionals, and we can't rely on kind of climate specialists, etc. It has to some of that expertise has to sit with the investment professional. It's a tough ask.
Yeah. Do you think, Ann-Maree, that there's a need for business schools and CFA type of institutions to actually be integrating it into their teaching, so it's not reliant on the investment houses themselves to kind of retrofit it onto their investment managers?
Absolutely, and I think many top tier schools understand this, and it has been integrated and is being integrated. But again, these things change quite quickly, and the issues we're facing globally change rapidly as well. So I do have sympathy for the fact that some of the information lags, and just when you think, oh, we've developed a wonderful ESG curriculum, for example, the next kind of wave of thought and how to approach and how to really deal with the issues comes about. But we are seeing it. I mean, CFA has a program. Most business schools, most universities have some sort of program that deal with this. But again, within a purely investment course, it's difficult because there's so many different strands of what you need to focus on. So I think a lot of the time it's from a very high level, this is how things can impact. But getting into the nitty gritty, which is where I think at the moment investment professionals kind of lack a little bit of that knowledge, that's the tricky part. But like anything, a new technology comes along, a new product comes along, and the investment professional gets up to speed when a company acquires another business or something. And I think understanding, using that frame of thinking to understand this is a good place to start.
Professor, I want to bring you in here because in your book you actually touch on this. You allude to the fact that accepted or traditional accounting systems are insufficient to actually help investors identify issues of natural resource depletion or limitations, etc. I'm going to test you on something. A traditional investor is trained at reading financial statements. A future unknown.
Alex, you cut out for a second. We heard a traditional investor is trained in financial statements.
I'm just I'm taking myself off camera here in the hope that you can hear me.
We hear you much better.
Sorry about that. Okay. So the question is that a traditional financial investor is trained in analyzing financial statements, which are typically backward looking, a year in the past. ESG, or when you're looking at the sustainability of companies, you're looking into the future. You're looking into a future unknown, whether it's resource constrained, whether it's climate change impacted, whether it's social license to operate, etc. What is your viewpoint on that?
Sure. Yeah. Look, as Ann-Maree pointed out, there's a lot of technical detail in the world of environment, social, not so much governance, because that has already been incorporated into traditional financial analysis. But the environment and social part, there's a lot of technical detail, which is not in the standard toolbook of an investment analyst. And it needs to be brought in. Part of it is that, I started my career out of college as an investment banking analyst, and we spent lots of time building cash flow projections and discounted cash flow analysis. And they never went out beyond 5 years. And so you spend time thinking about what could affect the business in the next 5 years and what could affect the cash flows. And then for the terminal value, you simply worked out some growth rate or some terminal value EBITDA multiple, and you were done. And the general investment managers incentive structure doesn't care too much about what happens beyond 5 years. All the ESG issues that matter are going to play out over, they'll certainly play out beyond 5 years. It may mean that, of course, the nature of the financial markets is that if I see something coming down the road in 5 years' time, and I understand it today, I'll start to price it in the marketplace today. And so the financial impact might happen in 2 years. But even 2 years is often beyond the horizons of many investment managers. And so that's why that capacity needs to be developed. It's more than just business schools incorporating the ESG content. It actually goes to a rethinking of the world view that's taught in business school, which is really about treating financial statements as we have them today as the only measure of success, or actually even worse, treating the stock price as the only measure of success. There's so much research in the governance space that shows the detrimental effects of stock buybacks on the ecosystem of investing. And when you look at stock buybacks, they're mostly driven by tax considerations and by the efforts of top management to reward themselves at the expense of long-term shareholders. But if you're persuaded to think that short-term stock returns are related to long-term value creation, then you'll create an ecosystem where everybody is working for the wrong measures of success. And so it's that cultural change that needs to happen. So I think in the book, yes, we do talk about the need to go beyond financial statements, but even more, we talk about the need to go beyond analytical monocultures, modes of thinking which are limited, which don't take into account new environmental or social risks that are coming up. An understanding that materiality is not something that is static, but is changing all the time. So which ESG factors, which ESG KPIs are important to the company that I'm investing in? There's a set that's important today, but I can look down the road and start to realize there's going to be an alternate set that civil society will start clamoring about because there are problems with this business model. So that kind of thinking needs to imbue the business school culture before that happens. As you know, our program at Columbia is not housed in the business school, partly because for new kinds of thinking, it needs to grow on new land. It needs to, you can't just plant, you can't plant new crops right next to the old monocultures.
Yeah.
Sorry, Alex, if I'm add something here. I think what's really interesting is that phrase of kind of change of culture of thinking, and what are investors incentivized by. So I know the types of mandates I have with my clients and what they ask of me, and I often want to challenge them. And I mean, my master's paper was on this, was why are pension funds not driving a lot of this? Because they're, as the asset owners, they're essentially the universal owners of assets across the world. And therein lies, if we can find a way to develop that broad thinking of that the entire globe owns everything and we all need to make it work. Of course, there are a lot of objectives that we need to meet and hit. But I think it's that kind of shift in thinking and trying to work alongside. I think pension funds and institutional asset owners are best placed initially to drive those kinds of conversations, because they speak for quite sort of big pools of capital, and they can drive change there. And they have across the world been big voices there. But I think that understanding of pension funds often are universal owners, and thus, you know, one bad thing happens to one company, it affects them, even if they're not invested now, they might be invested in the future. They need a universe in which to invest to derive returns, all of these sorts of things. So I think, I mean, to the title of Prof. Bose's books, this ecosystem of the world, not just of money, of everything is interconnected. I think that cultural shift needs to take place. And then the likes of investors such as myself, we are incentivized by our clients on certain metrics, and it seems perverse to go back to our client and say, well, please incentivize me on something else. But in some cases, there is that back and forth of, well, what is it that you're trying to achieve? And so things like we are signatories to the Net Zero Asset Managers Initiative. And why is that? Because we understand that we need a sustainable world in which to invest, so that we can continue investing for our clients and their beneficiaries. It's not necessarily something the clients always like or fully understand, but we understand that we need this full kind of ecosystem to work, and therefore finding ways to drive sustainability is a top-down and bottom-up imperative.
So, Ann-Maree, if I can just ask, I mean, you've spoken about how the pension funds are actually driving change. Are they prepared to accept the longer-term investment return thinking that ESG demands, and that would then perhaps make the managers more comfortable in taking a longer term, and as going back to the professor's point, being able to properly discount these ESG issues in the longer term and a typical, you know, discounted cash flow model?
I think it really varies globally. Different pockets geographically have different stances on this. So obviously kind of your Nordic regions, they're a little bit more progressive when it comes to this sort of thing. And there is that appreciation. In the South African case, and I can speak to that more personally, I think we have it a little bit tough here because there's so many issues to deal with all of the time, and the pension fund trustees and boards are often not just dealing with their investment outcomes, they're dealing with huge administrative burdens as well. And so the prioritization of issues within the landscape often, I think, gets warped because there are a lot of urgent things to address and not the important things to address. At this stage, my experience kind of across the board globally is that pension funds are not yet at a place where they can see that in order to achieve sustainable returns, you might need to forego, I want to say forego in inverted commas here, returns, investment returns in the kind of near term, in order to create an environment in which these companies can, or any sorts of investments can continue to thrive and deliver returns, not only monetarily, but from a utility perspective as well. And that's something I talk about as well a lot. You know, what is the kind of return on utility of your money as you're investing it, not just the investment return in 5 years' time. Is your money working for you? And if we can find a way to adopt that into frameworks of thinking, is your money working for you while you're investing it? I think that could go a long way too.
Yeah, it seems, I mean, it somewhat seems ironic that the pension funds are investing our money for a comfortable retirement, but if society and the environment is depleted to the extent that we might be retiring into a future that actually is not comfortable, regardless as to how much money we might have.
It does feel strange. I mean, to be fair, it is a complex set of issues. It's not just 1 + 1 = 2. Yeah, so I do have sympathy for the position that they're in, and obviously they're also advised a lot of the time by asset consultants. So getting asset consultants on board too, and there's a dynamic there between pension funds and asset consultants and asset consultants and investment professionals or investment managers. So there's a huge landscape to navigate and kind of change the culture of thinking in each part and then the dynamics in between.
Yeah.
Too.
Okay. Understood. We're getting a ton of very good questions coming in here. So before I turn to them, I just want to ask both of you the critical question around the ability of an investor with an ESG lens to be able to identify where markets are currently mispricing either assets or projects. Professor Bose, I'll start with you to get your perspective on that.
Sure. So you ask about ESG mispricing, and I think the key here is that because ESG means different things to different people, but also there is a commonality of needs. And so, and people are studying what's useful for their community going forward, and they're not necessarily seeing it in the ratings agencies' articulation of that, of those important factors. So ESG Alpha is about understanding what is good for society and is not yet recognized by the mainstream as being good for society. So I think, you know, Ann-Maree talks about investing in those companies which are improving on their ESG metrics, but they don't look so good right now. You know, it's finding beauty. ESG is beauty in the eye of the beholder, but you can make a good living looking for beauty in the uncut diamond, to use a South African metaphor.
Yeah.
You try to sell that uncut diamond at Tiffany's and no one will want to buy it. But those who know what it's actually worth and what it can become will pay a lot for it. So you have to figure out, and in order to find that uncut diamond, you're not going to walk on Fifth Avenue. You're going to go and look, dig somewhere in the Karoo to find this thing. So ESG Alpha is about looking for information that's not widely available. And what happens when you do that? When you go and do that, you are you're letting the world slowly know about something that's useful for society that society broadly didn't know before. So you brought information into the financial ecosystem, which is helpful for society. And along the way, hopefully you earn a living from it because you found something with hidden value, and it'll take time for everybody to understand that value. So that's really what ESG Alpha is about. Ann-Maree pointed out the universal owner. ESG Alpha is much harder for the universal owner to do. And for the universal owner, they have to be focused on ESG beta. Both are forms of mispricing in a sense, in that the universal owner can't nimbly jump from one position to another because they found a diamond in the rough and they now want to buy that. A large owner trying to do that will get front run and will lose all the value. But what a universal owner can do is, by engaging with companies, it can affect the whole sector and say, look, here's an issue that you guys haven't been thinking about. Why don't we have a conversation about it that will help the sustainability of your financial return and will help society broadly? And that's much more of a broader argument. The ESG beta activist, so to speak, is not operating alone, but is walking together with the whole tribe, so to speak.
Okay, thank you very much for that. Ann-Maree, your thoughts?
Yes, I completely agree with that. There are two other elements I'd like to add to that. The first is, I don't think an ESG lens through using ESG ratings is necessarily going to be the thing that generates you ESG Alpha. And there are many studies that have used ESG ratings to prove that ESG investing is a great way to generate returns. I'm not sure that is necessarily true for many reasons. One, ratings themselves are so disparate between different rating houses. And over time, in different universes and different geographies, those studies have also fallen flat. I think, and that leads me to my second point, the key thing is, well, what are the ESG things that we are looking at? And it's really knowing those investments well. In the South African context, we're quite fortunate, I think, and I know there's a broader audience here, but we're quite intimate with the universe and understanding how these companies operate. And so being able to pick out particular E, S, or G drivers should be a little bit easier, and therefore be able to help us find those additional sources of information which can unlock value into the future. The second thing I wanted to say, though, I think is also depends on what your investment style is. You know, there are different investment styles. If I just talk to a listed equity, for example, within the 91 house, we've got value, we've got quality, we've got momentum, we've got all of these different things. And I think, again, you have to adapt ESG to and for those styles. So the biggest equity team in the South African investment floor in South Africa for 91 is a factor-driven team. We look at earnings revisions and valuation. And so our ESG approach is, well, where do E, F, and G things impact line items on the income statement that will affect earnings revisions, because that is within our process, and then as well impact valuation because it's within our process. And I think that's a very easy case to make, because it's within process. And hopefully, if you believe that your investment philosophy or style works, you should believe that whatever ESG lens you bring that works within that sphere should deliver an ability to generate alpha. And I think ESG can work in any investment style when used in that way. So I think there are a number of layers and ways in which ESG can work, and in which ESG I think won't work. And we'll see, and we've seen that over time.
Yeah. Okay. Thank you very much. I want to bring in some of the questions that have been coming from attendees. We have a final 20 minutes here. The first one is the role of, in this case, it mentioned the sustainability accounting standards, which I think will become part and parcel of the ISSB. Are these standards not sufficient for investors to get a proper understanding around the ESG issues that their investees might be grappling with? I.e., I think this is a broader question to the fact that we have a lot of reporting frameworks out there. Are they sufficient for investors to act on? And I guess the flip side of that coin is, do investors really understand what's in those reports in the first place? Professor Bose, your thoughts?
Sure. Thank you, Alex. This is a great question, and and one that doesn't have an easy answer. I did write a paper about this that's not in the book that you mentioned, and it's called Evolution of ESG Reporting Frameworks a couple of years ago. And my thoughts there were that we need something that allows interoperability, allows consistency, so that we all know what we're talking about when we refer to a KPI. And so in order to fulfill that need, you need SASB or GRI, these types of frameworks and standards. So it makes it easier for us to communicate. But there's a flip side to that. And the flip side is that when you regulate, and SASB is not a regulation as such, but when you regulate what words can mean, you make it easier for two people to talk to each other, but you also limit what they can talk about. And there's a great movie by Jean-Luc Godard, I think from the 1960s, and it's called Alphaville. Most of my students have never heard of it. I'm dating myself, but this movie is about an agent, a secret agent who lands up in a place called Alphaville, which is run by an authoritarian dictator. And that a key activity that authority is trying to implement is to reduce the number of words that people are allowed to use. And Godard understood that language was how we express our most innermost feelings. And if we could limit the words, the language, then our ability to question and to have critical thought would be hampered. And so the point about ESG alpha is that if you absolutely need to have standardization of concepts, but they are not the be all and end all. You have to go far beyond that. And I think that's where the role of managers like Ann-Maree comes in, because the SASB frameworks of the world, they will make things somewhat easy for those who don't have much time and for whom it's not their business to study companies and their prospects. But there is a whole bunch of professional investors out there who have to study much more carefully. They absolutely cannot just rely on those frameworks. So the kinds of people who say, oh, ESG is terrible because the frameworks aren't yet sufficiently developed, it makes our work so difficult. I don't see that. The professional investors thrive in conditions where there is, where there's many different kinds of meaning to the same thing. And that it gives them work to do, to go and look for it and understand the world. And so, to generate ESG alpha, you've got to move beyond those standards and those reporting frameworks. So okay. Yes, it's important, but it's only important in the very first stage.
Ann-Maree, do you use them? Do you use these various reports that come out, whether it's CDP or SASB, or and if so, how?
Yeah, so we use them for exactly the reasons both reported. One, as a sort of just a first step into the investment case around what is the landscape, and how do these companies fit in the landscape with respect to ES or G elements. And it's just a first step. The second thing then is, well, as an investor, it is my job to unearth and unpack what are the driving forces that are going to make this company successful in the future, and what are the ES and G elements that fall within that scope. And then I go and see whether I can kind of mosaic theory it out of all the information that I have. I ask if there's other information that can be provided publicly or to me, depending on what it is. I look for what the management teams are incentivized by, and whether that is appropriate with respect to those elements. So it's a great first step. From an investment perspective, there's a lot of building that is done on top of that. The other thing I wanted to touch on is the kind of the CDPs and any other type of disclosure regime. I think is important for accountability and driving kind of global change. So we join many campaigns to get reporting done, for example, CDP, because it provides accountability with respect to sustainability on a global scale. And we want to see all companies move forward in more sustainable fashions, because we all need the world to be a better place. We all need answers and solutions. If I just take net zero, for example, we all need to see transition plans that are going to help or assist in that regard. So that's kind of an additional layer with many other agenda points there that we want to see those things. From an investment perspective, I would say the SASBs or the GRIs, lovely starting point. But if I'm going to be a good investor, I need to build on that and really push into, well, where are the opportunities and where are the risks?
We have a question here around the role of audit firms. I think this is more a question also around assurance. How can we be assured that the information that is being provided by companies around their E, S, and G performance is correct, and to what degree do we need to push that side of the audit profession?
I think to a very large degree, I need to rely on that information, much like I rely on any other financial metric or number in the set of financial statements. So it has to be a key element. And the auditors need to be trained on it as well, and understanding what to look for, where the pitfalls may be. I mean, I know a lot of bodies also do external or third-party verification, which is what CDP does, and that is helpful as well. But part of the auditor's role is to assure lots of lines of work within a business, including the financial statements, and I think this just needs to be one of them.
Professor Bose, are you seeing it at audit firms stepping up to the plate on this?
Well, look, the sustainability information, very little of it is actually currently assured by auditors. And even the kind of regulation around it, disclosures today, envisions assurance only for some very well followed and relatively easy to compute KPIs, for example, around carbon accounting. But there's a lot that can be done to increase assurance by auditors, firstly on carbon accounting, but then starting on other related KPIs as well. Yes, I mean, there's certainly no shortage of disclosures which have been viewed by no one other than the issuer. I would caution that the auditor will make us be sure that there isn't a problem. I mean, you only have to know about the Enron case. There's no shortage, even in recent history, of issuers with perfectly good audit reports that crashed and destroyed the savings of their investors and employees and so on. So the nature of scrutiny is that everyone has to look carefully. There's a nice book called The Wisdom of Crowds, which talks about this issue, and this is about analytical monocultures. I think the quote, I don't have it in front of me, but it's something like, it's very important for us to rely on the wisdom of crowds, but if the crowd all thinks the same way, if there's no diversity of approach, then there's really no point in having the assurance of the crowd or the expert for that matter. So it's important to test and ask questions even about KPIs that are assured.
Okay.
And that's where the training comes in.
Yeah, thanks. We've had a couple of questions here talking about the political scheme of things, or to what degree should there be government intervention to promote ESG, either from an investment perspective or from a reporting perspective from companies. I wonder if either of you have any view on that, or should this kind of activity be outside of the realm and almost self-regulated and driven by the industry itself? Ann-Maree, you go first.
Tricky question to answer. Well, I think certainly those elements those items which speak to a country's goal, certainly there must be government intervention, and many of the E and S and G items do, or factors do. So I can't imagine a world in which E, S, and G is taken seriously and there isn't government intervention or regulation of some sort, because these are really important things. They are not nice to have. They affect and impact the sustainability of governments, of countries' well-beings, etc. So I would imagine that is the case. I think where there might be a little bit more caution is necessary is, well, regulating how investors, the dynamic between investors and how they deem fit to invest. I know that obviously in South Africa, we have Regulation 28, which speaks to the fact that pension funds should take it into consideration. And I think that's appropriate language, because you want to make sure that those bodies that have the authority to make the appropriate decisions with the information that they have are free to do so. So I think there needs to be language that allows consideration and allows for consideration. I think we get into sticky territory when governments mandate specific things, particularly because ESG means so many things to different people, and particularly in the sphere of kind of ESG funds. And we've seen some of the tricky the things we're running into Europe at the moment, the way the categorization on particular funds, what they mean, how you disclose it, etc. And I think if there's consideration and things that address the intentionality, and there are ways to do that within regulation, that it's not prescriptive, I think that's probably the wiser route to go, particularly at this juncture and point in time where there isn't a lot of information to go on.
I just want to test that very quickly, if you don't mind. You said it's something like Regulation 28 is appropriate. My question is it sufficient?
I think I can get myself into trouble here. I think it's sufficient in an environment where we have empowered trustees. I think part of our issue at the moment is that our boards of trustees are maybe not well equipped enough with knowledge, understanding of objectives, scope, time, education levels, all of these sorts of things. So I think it's appropriate in that, or sufficient in that context. We don't live in a context like that, and I think that's where the desire to become more prescriptive sort of starts to play out, because that would, if you say you have to do A, B, and C, that seems easier, but it's not always the best suited thing for every fund or every investor to meet every objective. So I think in a world where we have better equipped boards, or particularly around ESG and environmental and social items and factors, it would be sufficient.
Okay. We're talking here a lot about the need for trustee understanding. It sounds like there's a need there for training and awareness among pension fund trustees in terms of what these ESG risks and opportunities on the flip side of the coin could present to them. Professor Bose, is that a global phenomena? And directly linked to that is a question coming in around the role of asset advisors and investment consultants. Can you give us your thoughts on that in terms of what you're seeing in the US and other markets?
Sure. So to support a little bit Ann-Maree's point, I think the governments have a very important role to determine what the goals are for that country. I've actively supported many of my former students building taxonomies around in the countries that they're focused on, rather than, for example, taking the EU taxonomy, because it was very clear when the EU taxonomy came out that it was one view of the world that didn't even hold true within the EU, never mind for the rest of the world. So I think it's very important for governments to build the capacity to think about what's important to them in terms of environment and society, and how to articulate those goals. The second part, which is how do we get to those goals? How do we implement a path towards getting to those goals? It's very hard for governments to get that kind of expertise and to lay down this is the set of paths. They have to rely on a range of knowledge that's distributed throughout the marketplace and in society, which is why it should be about, consider this, as a pension fund, you should integrate ESG into it, but we're not going to tell you what to invest in. You have to make that decision. You have a fiduciary responsibility to your beneficiaries, and you have information. If the government steps in and says you should do this, then the fiduciary is going to be absolved of all their responsibility. There's a lot of good research out there by a woman named Eleanor Ostrom, who won the Nobel Prize in economics a few years ago, about the situation where a regulator tells the fiduciary what they should do, because then the fiduciary has nothing riding on their decision. They can just CYA, so to speak, and say that the regulator told me to do this, even though I had better information. So it's very easy to do overreach there. Let me address your question about the investment consultants and advisors. I mean, I think it's as you say, the pension fund trustees often do not have the capacity, because this is all new information. There's a lot of science involved, and it requires study. And there is a lot of effort, in my opinion, not enough, to that's put into training trustees, providing them with the information needed for them to think about the needs of beneficiaries and address them. It's all too easy for the investment consultants to step in and be prescriptive there as well, but it's much harder for the investment consultant to come in and provide the information and then rely on the trustee to think about what the beneficiary needs and have a dialogue and an exchange. And I see the good consultants doing just that. But I also see a lot of instances where the consultant will simply not try to educate the trustee, but will say, this is what you should do. It'll be more of a paternalistic approach. In teaching, I've spent a lot of time teaching. In teaching, I found that if I lecture in my class and say, this is the right thing to do, nobody listens and doesn't have much impact. On the other hand, if I present the students with a case and I ask them, what would you do in this situation with this information and this decision you have to make? And they think about it, 9 times out of 10, they'll come to the right decision for them. It may not be the right decision in my mind, but it'll be the right decision for them, and it'll be considered. And that's really the way that the investment consultants have to go.
So it's an interchange of ideas in many ways.
Yes, and information.
And information. Most unfortunately, the time has flown by. We're going to need to wrap this up. I apologize for the slight technical challenges we had and I having to take my camera off, but I must thank you both for the incredibly rich discussion that we had. Ann-Maree and Professor Bose, that was absolutely fantastic. We have received many questions here. We were only able to touch on some of them. What we will do is try and capture all of these questions, and where appropriate, perhaps send them through to you for some quick responses so that we can pass that back to our attendees. The attendees, I would like to thank very much as well for you being here and actually making it such a vibrant discussion in those in the last 20 minutes. It was absolutely fantastic. I thank you both. I thank you, Carolyn, and the ESG Exchange. It was a dynamic discussion, and let me hand over to you, Carolyn, just to wrap it up.
Thank you very much, Alex, and thank you very much to everyone for attending. And I have put up the page for the next First Tuesdays event on the 4th of April, the 4th of the 4th. Looking forward to seeing everybody there. We haven't decided on a time just yet. We have decided on the topics, and the presenters, the expert panel, are still busy confirming in terms of their attendance. I can announce that this is that event is being sponsored by Novisto, which is really really a lovely gift for us as the ESG Exchange. Thank you very much, everyone, and the recording is available on the event page. Thank you, Ann-Maree, and thank you, Professor Bose.
Thank you.
Thank you, Caroline. Thank you, Alex. Nice
Thank
to
you
meet
all.
Ann-Maree.
Have a